Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Alasdair Macleod with me once again. And I really feel fortunate to have Alasdair with us these days because he is very much sought after for his understanding of these markets, which appear very strange to most people. From Alasdair's rock-solid understanding of real-life economics built upon the rock-solid foundation of Austrian economic theory, he is most helpful in making some sense out of what appears to otherwise be chaotic, nonsensical happenings in the markets. They just don't seem to make any sense based on solid economic data and what seems to be happening. The disconnect between the equity markets, for example, and the business environment doesn't make any sense at all until you start to understand what really is driving the markets, and that's where Alasdair is really very helpful to us. I would suggest strongly that you avail yourself to Alasdair's weekly insights. His essays that he writes comes out every Thursday. Go to goldmoney.com. It's the Research Gold Money Insights page, and it's just excellent. And so I want to thank Alasdair. Thank you so much, Alasdair, for joining us again. I know it's late in your day over there, and you've had some technical issues. Boy, I'll tell you, technology is great when it works, but when it doesn't, it can be one of the most frustrating things in our lives. And I really, really thank you for being with us today, because I know it's been it's in general, these have been trying times. And then when you have other things that poke you in the eye, it doesn't make life any easier. So thank you so much for being with us.
No, well, thank you very much for asking me. It's very much my pleasure, Jay.
Well, thank you. I want to believe that, but somehow I think you are so much sought after that I have to think that if I were you, I would be getting annoyed that so many people want to take up so much of my time. But I thank you anyway. You've written an article on July 18th that appeared at the Mises Institute that I picked up on, and I normally read everything you write that's at Gold Money, but this one, inflation this time is different. Before we get into the reasons why this time is different, could you maybe just quickly review the credit cycle and where we are in it at this time? I know you've gone over it many times in the past, but the credit cycle as opposed to the business cycle. Most people refer to this as a business cycle. You point out this is a credit. What we're talking about now, what the real driver is credit. It's credit that drives the business cycle, not the other way around. It should be the other way around. But anyway, could you just go over that with our listeners and talk to us about the cycle, where we are in it now, where we are in that right now?
Yes, of course. I mean, basically, the credit cycle is something that started when banks began to issue credit which was not backed by gold, going back into the old days. And the effect of that was that the credit obviously stimulated activity because it goes into the economy, masquerading as, in those days, gold-backed money. It wasn't gold-backed, it was credit. And consequently, by stimulating the economy, the bankers got more confident about how things were progressing, so they made more credit available. And the process sort of built up until they had typically something like 10 to 12 times their equity out on loan to business customers. And then there comes a point where the expansion of credit meets an obstacle, and that is the limitation of the amount of other forms of capital available. And by that I mean labor, commodities, the machinery, if you like, to make things. Suddenly you find that there's a queue to acquire this machinery. And consequently, you get blockages, you get things, suddenly you've got problems in the economy, and prices start rising. Now, at that point, obviously, interest rates have to be increased in order to keep some sort of balance in the situation. But bankers then begin to worry about the amount of risk that they've actually got on board. And when you've expanded your balance sheet to, say, 10 or 12 times your equity, that's lovely while things are going well. But when you begin to worry that perhaps they're not going to go quite so well and there's a bit of risk coming in, then what happens is you start trying to contract your balance sheet to control that risk. And inevitably, it's not just you. You've got other bankers who are thinking in exactly the same way, and they're probably watching what you're doing, and you're watching what they're doing. Mm-hmm. So all of a sudden, the whole of the banking community starts getting worried about risk rather than being greedy for profits. And at that stage, you get, if you like, a crash in the availability of bank credit. Now, this is something that goes on despite the attempts of central banks to try and inject money into the economy. When the commercial banks seem to be stepping back or getting cautious. The result is that sometimes the effect of the contraction of bank credit is covered by central bank actions. You find that you go into a recession, and it's not too serious, and somehow you get out of it. But sometimes it's not quite so good. And if you look back to 1929, that was the classic. In 1929, that was the end of a period of massive credit expansion, which gave you the roaring 20s. And at that time, 1929, they increased tariffs. There was the Smoot-Hawley Tariff Act, which increased tariffs, American tariffs on all imported goods by around about 20%. And it was the combination of those two things, the sudden contraction of bank credit, which affected stock prices because a lot of the bank credit had financed purchases of stocks, and the Smoot-Hawley Tariff Act, coinciding at that time, led to the Dow Jones falling from September 1929 to, it was sort of July 1932, a total of 89%. Mm-hmm. Now, in terms of the credit cycle, we are at that point, really very close to the top. We've seen an initial move down, some sort of recovery in stocks. Now, that could go a bit further. It might not go a bit further. It is very dangerous. There is money being produced which is actually going into the financial assets rather than into the underlying economy. Now, having said that, when that begins to fail, then you've got the second leg down, the one which took the Dow in 1930, around about, I think, May 1930, down to that low in 1932. We've still got that ahead of us on the analysis of the bank credit cycle. So it's very important to understand it.
Mm-hmm. Absolutely, and I might just add that our Michael Oliver, who's on our show, from a technical point of view, sees very much the same thing. He believes that the next, and he's made the comparison with the 1932 decline from 1929 to 1932. Everybody thought we were off to the races and things looked good again to most people. Bounce back off the lows, just as we had a bounce back off our March lows, and people are singing songs, and you turn on MSNBC or any of these channels, and they're all talking about how great things are again, and they're trying to cheerlead the economy on. But Alasdair, back at that time, we were on a gold standard, and yet we still had these problems. Of course, Keynes and the liberals they blame the gold standard for the problems. Why are they wrong?
Well, that is not. I mean, you're right. They do blame the gold standard. The problem with the gold standard was it was a straitjacket. It didn't really allow the central bank, the Fed, to expand the amount of money in circulation as much as it needed to, because it had to work on a rule-based gold standard. Now, the people who see gold, if you like, as an impediment are basically inflationists. This is the Keynesian idea that you need to stimulate the economy by printing money. And obviously the gold standard prevents that. There will be differences this time in terms of the price effect of, let's say, a slump, a new slump, which is a natural consequence, if you like, of a bank credit crisis. Now, when it happens this time, you've got fiat currencies, and fiat currencies will lose purchasing power. They're designed to do that in these circumstances because the Keynesians believe that it will stimulate the economy. But the fact of the matter is that it's got very little to do with it. If they actually stood back in 1930 and just let the economy sort itself out, that would have resolved itself in probably no more than 18 months to 2 years. And that indeed was the experience of the previous slump, which was back in 1921. 21-22, it lasted 18 months, and that was it. But when government gets in the way, it stops the process, if you like, of capital reallocation from businesses which have grown fat on bank credit, have lost, if you like, their way in terms of generating profit without that credit. In the absence of that credit, those companies should go bust. New technology, new management, new entrepreneurial expertise can redeploy that capital to more effect. And that is, if you like, the sort of the new effect. I should be called it creative destruction.
Sure.
But that is something that, if you don't interfere with the economy, if you just have sound money, you find that evolution in business is going on all the time. And that is a good thing. That is called economic progress. The problem with interfering with economic progress is you get no progress, and then the whole thing starts going wrong. And that was really the problem of the 1930s, not the gold standard.
Okay, you mentioned in your in that article that the reason it's different this time, you compared it with 2008, the financial crisis. You noted there that financial crisis, that it was in fact a financial crisis. It started in the financial realm. This time it's starting in the real economy. Explain to us why that's a big difference between now and 2008.
It is a huge difference. I mean, if the problem starts, or it is broadly confined to the financial sector, then you find that it's banks, you find that, investment managers, you find that, everybody who's invested in these things suddenly starts losing a lot of money. Now, that does have an impact on the underlying economy, but the impact is really not that great. If the problem starts in the underlying economy, the real economy, Main Street as opposed to Wall Street, then this is a far, far greater problem to deal with. And this is what we've seen with COVID-19. I mean, this is, if you like, very much a test case for us. It shows that, when you close businesses, people go unemployed. This is just massive, absolutely massive. And it's going to take some time for businesses to recover from this. Obviously, governments and investment managers hope that it's a V-shaped recovery. In other words, as soon as lockdown really ends and we've dealt with it, then we go back to normal. But that's not going to happen at all, because the whole thing has destroyed so many businesses. And it's not just the large businesses, it's the medium and small businesses, which make up to 80% of any economy, including the American economy. It's all those unsung heroes who produce things that we want, the goods and services. The people, sort of out of the cities who, are builders, decorators, sort of own restaurants, all the rest of it, all these small businesses, they're the ones who are really suffering. And that is, that has enormous consequences. It really does.
No, indeed. And I'm just looking at an article here on Zero Hedge. It says, like nothing we've seen, imminent eviction wave is coming to these states in August, predicting upwards to 2.3 million evictions. I think these are home evictions. We're seeing a massive number of course, America and Canada too, had huge amounts of retail space. The retail sector was in trouble before COVID, and now it's just being absolutely devastated. So I can't imagine that there's not going to be a huge cry from the bankers for their daddy at the Fed to bail them out too. And then you have this situation with the retail, with people, with masses of people unemployed, not able to pay their rents. Alasdair, it's very frightening.
It certainly is. And, of course, the banks, if you like, are stuck in the middle of this. Going back to what we were talking about the credit cycle, they are desperately worried about all their commitments out to people who are going bust. So what are they doing? They're trying desperately to cut those commitments at the same time as the Fed is saying, oh no, for goodness sake, don't cut the commitments, lend more money, keep the thing going, and it'll be a V-shaped recovery, and we'll all be all right at the end of the day. But the bankers don't believe it, and who can blame them?
Yeah, I mean, it wouldn't make sense. The bankers have a fiduciary responsibility, or at least at once they did. I don't know if they take that seriously anymore because they know the Fed will always be there to bail them out. I know as a credit analyst many decades ago, working for banks in New York City, I thought I was doing something good. I was helping to preserve the capital, I felt, by doing a conscientious job and evaluating whether or not the borrower could pay us back. But that seems to be something they don't worry about too much anymore. The Federal Reserve can just print money. I want to ask you really this. I want you to help us understand a little bit about Keynesian's the Gibson's paradox, which Keynes was a paradox to Keynes, I guess. But as I understand it, Alasdair, Keynes believed that. I mean, he was perplexed by the idea that the bond rates and inflation were going up together. I guess if I understand this right, Keynes thought that with lower interest rates, we should get more business activity and hence higher prices. Do I have that right?
Now, basically, what he was doing is he was because he couldn't work out Gibson's paradox, he ignored it. And really, if you ignore Gibson's paradox, then basically you can believe that lowering interest rates will lead to an economic recovery because people will go out and borrow. And so he was very much an inflationist who believed in the lowest interest rates possible. He also had a problem insofar as presumably a lot of his friends, the idle rich as it were, had trusts which had capital, which earned income in the form of interest, and it allowed, the sort of, if you like, the wealthy, the Belmond of the day, to live a very nice life without actually having to get their hands dirty. And I think this thing was something that Keynes really reacted against. So he didn't understand capitalism, if you like, from the point of view that savers provide, by deferring their spending, they actually provide the capital for businesses. And the process which Gibson's paradox really showed is that it wasn't so much savers deciding to divert money from their current spending to lend to businesses. What happens is that businesses have to bid up for the money. So from the point of view of a business, it is an expense, if you like, which is an expensive business. The interest rate that they pay on money is an expensive business. But the one thing they do know is what price they can expect to sell their product at. I mean, it is the fundamental function of an entrepreneur to assess that. And as far as the saver is concerned, what you've got to overcome is the problem that the saver, if you like, will value money on the basis of comparison, actually having it today as opposed to having it at a date in the future. This is called time preference.
Sure.
So the two things are rather different. Business looks at it as an expense, which it uses in its business calculation when it is evaluating a project to invest in. But ordinary individual savers regard it as a time preference problem. In other words, they're being asked to part with their money and only get it back at a later date. Now, there has got to be a reward for that, as you may understand. And no amount of fiddling around by a central bank is actually going to change that fact.
Right. Well, of course, this is the religion of the day and has been since Keynes and since Nixon said we're all Keynesians now. This is the economic religion of our time. And it smacks, talk about science, talk about evidence. It's the opposite, isn't it, Alasdair? If you look at the more money they've shoveled in, the less robust our economic cycles have been, our credit cycles have been. And so the evidence runs contrary to that, does it not? What we're seeing in the last several decades.
The best example of this is to look at what Japan and the Eurozone have done with interest rates. They've made them negative. Has that sparked an enormous revival in their economies? Certainly not.
Not at all.
No, so you can see that the idea that you can actually manage an economy by manipulating the interest rate is disproved. It's as simple as that.
Yeah, and I would just say to people that are really interested, Alasdair's article, the one I just referred to, on that talks about Gibson's paradox, is posted at goldmoney.com. Well, Alasdair, with just a couple of minutes left here yet, I have to ask you, what do you make of this? We have seen now, I believe, a new high in gold. I know I chart the monthly average from the London PM fix. I do that every day, and I know that our average for July is most certainly the highest ever, higher than back in 2011. And so it looks like we're on to something. James Turk called it the leading edge of a tsunami now. And I'm seeing here, all these millions of people that are going to be thrown out in the streets, supposedly. Yeah. It's just hard to see how that's not going to be the case from my perspective. What are your thoughts?
In the very short term, we have a crisis in the gold paper markets. It started off with the crisis on COMEX, and you saw that COMEX went to the COMEX gold contract went to an enormous premium over London spot.
Yes.
Now what's happening is something very interesting, and that is that London spot is trading at a premium to COMEX, and this tells me that there is a shortage. I mean, we knew there was a shortage of bullion in London, given that it is used so extensively. I mean, it just turns over at a hell of a rate. But now that shortage is really beginning to bite, and that is why you're finding that the London spot price is going up above COMEX. And I think we're going to enter a second phase of the crisis, which is going to drive precious metal prices, gold and silver, significantly higher. The problem with it is that this is creating a crisis in the bullion bank fraternity. I mean, already on COMEX, they're adrift by something like, I was calculating it the other day, but I think it's been in the region of $38 to $40 billion spread between 27, 28 bullion banks. That is an enormous amount of money, and it is not spread evenly. So we're getting into a situation where bullion banks could well become insolvent, or those desks could undermine the stability of the banks that actually own them, because all bullion banks basically are part of bigger banks.
And the entire banking system. Alasdair, we're going to have to leave it go at that. We're out of time. Thank you so much. That's a topic for another day. Thank you so much for being with us.